Good afternoon, ladies and gentlemen, distinguished guests. Welcome to the 7th Annual Caplin Conference on America and the World Economy. My name is Gerald Baliles, and I'm the Director and CEO of the Miller Center at the University of Virginia. The Miller Center, for those of you who are not familiar with it, is a nonpartisan institute that focuses on the studies of the American presidency, political history, and public policy issues of importance to the governance of the country. It's the leading organization in the country looking to provide historical insights into the policymaking challenges confronting the country. These insights, we believe, put today's policy debates in perspective, and they point toward a framework for practical, lasting solutions at a time when sound, nonpartisan thinking, grounded in the perspective of history, is certainly needed. One of the ways we do this is through major policy conferences, and through the generous support of Mort Caplin, we launched the annual Caplin Conference in 2008 as a vehicle to address the most pressing financial issues facing this country and the global economy. So in September 2008, during the early months of the global economic downturn, our inaugural conference convened 12 former finance ministers from around the world to recommend a blueprint for a new financial architecture. Since then, we have addressed topics ranging from how to govern through debt and deficits, to the impact of high-skilled immigration, to potential free trade agreements between the United States and the European Union. We've gathered some of the world's leading thinkers in business, economics, and finance, including Paul Volcker, Christina Roma, John Snow, Jean-Claude Trichet, Mark Warner, Alice Rivlin, Steve Case, Mervyn King, Robert Samuelson, Fukiya from the Bank of Japan, and Zhou from the Bank of China, among others. And as in years past, the topic of today's Caplin Conference is of great consequence to the global economy. How the public and private sectors should govern in this era of unconventional monetary policy. On Tuesday and Wednesday of next week, the Federal Open Market Committee will hold its final meeting of the year. This meeting will also include the customary end-of-the-year press conference by the Federal Reserve Chair, Janet Yellen. So we've gathered at a pivotal moment in this process. Global monetary policy has been the focus of much debate in recent years. These discussions, however, often focus on the perspective of one bank or one economy. And we believe that for the dialogue to be productive, it is vital that more than one perspective is required. And so we have chosen to focus on the global perspective, that it be considered and understood. So that's why we do things a little differently with our Caplin Conference. Each year, the Caplin Conference convenes two separate gatherings, one in the U.S., here today, and one with an international partner. This year, we're delighted to collaborate with the London School of Economics, one of the world's prestigious institutions of higher education. LSE will host its conference in London on January 19th. Upon conclusion of that conference, the Miller Center and LSE scholars will craft a joint report featuring recommendations on a path forward that will be disseminated to key policymakers both here and abroad. I'd like to welcome Professor Charles Goodhart to the lectern to offer a few words about this great partnership. He's the Director of Financial Regulation Research Program at the London School of Economics. He served previously at the Bank of England as a monetary advisor, and then chief advisor, and then subsequently as an outside independent member to the bank's Monetary Policy Committee. It's been a pleasure to work with Charles and his team in putting together this partnership, and I'd ask him to come forward for a moment for a few words.
Governor, thank you very much. It's a great honor and privilege to be the partner of the Miller Center for this Caplin Conference. You mentioned Jean-Claude Trichet. When Jean-Claude wasn't quite certain how he should address the gathering, he always started, "Dear friends," which I think is a very good way of doing it. So, dear friends. You said that we had a lot of pressing financial problems. Actually, I received an email overnight from a journalist in the London Times who asked me what I was most frightened of. Are you most frightened of bond market crash, oil price volatility, a sovereign default in an emerging market country, a financial institution going into default, a breakup of the Eurozone, a hard landing in China, or other? To which the answer was all of the above, but especially other. Because it is what you do not foresee and can therefore hedge against, which actually causes you the greatest damage. It is actually a fascinating moment to be discussing financial affairs because the world is beginning to fragment in a way that hasn't happened so much beforehand. And since 2008, virtually all the developed world has, in a sense, been in trouble together. But we're now seeing a division with the US, and I'm glad to say my own country, the UK, moving back towards normalization, while the Eurozone and Japan are not. And equally, we are seeing a division between the raw material, energy, and commodity countries whose prices are going down, and the importing countries which are benefiting. And quite how this fragmentation of our world into parts is going to play out, none of us knows. But particularly the oil price movement has been so fast that any fast movement is likely to have significant difficulties. But there is one constant, which I'm prepared to say will remain. And that is, when the US was engaged in expansionary policies and quantitative easing, you were blamed for currency wars. And as you normalize and interest rates go up and the dollar starts rising even further, you will again be blamed. The one constant is, whatever happens in the world's economic conditions, America will get blamed for it. That you can rely on. But that means, I hope, that the rest of today's discussion will be interesting, productive, and I look forward very much to hearing what goes on in the rest of this afternoon, other than my own extra words, and I look forward very much to welcoming those from the University of Virginia's Miller Center over to London for the return match in about a month's time. Thank you.
Thank you, Charles. Before we turn it over to the first part of our program, I want to pay special recognition to a few people. First to Mort Caplin. Mort Caplin's very generous gift has made possible this annual conference on the global economy. Distinguished alumnus of the University of Virginia, a scholar, public servant, nationally recognized tax counselor, and friend, and former member of the governing council of the Miller Center. Mort's important support of our public service mission at the Miller Center over the years has been steadfast and indispensable. We are once again delighted to have him in attendance here today. I know that sometime during the day, perhaps this evening as well, his son Michael and daughter-in-law Christina will be with us. But Mort, thank you very much for your years of friendship and support. I'd like for Mort to stand and be recognized and receive our applause. Let me also recognize the chairman of the Miller Center's Governing Council, Gene Fife. He's a former partner at Goldman Sachs, who established and managed that firm's banking presence in San Francisco and London during the 1980s and 1990s. He's now a founding principal of Order Capital, LLC. It's a private equity firm headquartered in Charlottesville. He's on the board of Caterpillar. He's very well known across the world of finance. He's a wonderful friend, a great supporter of the Miller Center, whose advice and counsel we all cherish. And Gene, I'd like for you to stand and be recognized. And let me also point this out. As some of you may know, on December 31st, I will be retiring from the Miller Center after 8.5 years. We conducted, that is, the Miller Center conducted, a national search for my replacement, and it was somewhat exhaustive. And I do not think we could have found a better successor than Bill Antholis. I suspect Bill's name is familiar to some of you here. He's an eminent scholar and the outgoing managing director of the Brookings Institution, and before that served in senior leadership positions in government, including as director of international economic affairs at the National Security Council and the National Economic Council, and also as deputy director of the White House Climate Change Task Force during the Clinton administration. Most importantly, he is a graduate of the University of Virginia. I know he will make an outstanding director for the Miller Center for what I hope will be a very long time. Bill, please stand so that we can recognize you. And finally, let me recognize and thank the faculty and staff of the Miller Center, and especially the dedicated efforts of our Director of Policy Programs, Jeff Chittister, the Miller Center's Newman Professor of Governance, David Lebland, Lead Policy Analyst, Tony Lucadomo, Communications Director, Christy Shantz, Events Coordinator, Reed Forbes, and my Executive Assistant, Rosemarie Owen. Today, we will enjoy the fruits of their many months of attention and hard work to the details that make a conference such as this possible. And now let me bring David Lebland to the podium to get the program started. He's the Newman Professor of Governance and Chair of the Department of Politics at the university. He's a faculty associate at the Miller Center and a specialist in political economy. He has served as a consultant to the International Monetary Fund, the Directorate of Finance and Economics of the European Commission, and the Department of Defense. He's also the co-author of a book entitled Democratic Politics and Financial Markets, Pricing Politics in 2006, and more than 25 journal articles in publications including the American Journal of Politics, International Organization, Economics and Politics, and the Journal of International Money and Finance. So David, please come up and get us started.
Good afternoon. Let me add my welcome to that of the governor and a thank you to Charles and the LSE for partnering with us for our follow-up event. Last March, when we first started working on this event, we were unsure of the state of the global monetary policy come this conference. The Federal Reserve had only just started winding down from an extended period of what was described as extraordinary monetary policy, although Michael Bordeaux, who penned our background essay and is a panelist, reminds us that this period is really not as extraordinary as we might think it is. But we thought this was, the unwinding was pretty extraordinary, and we didn't know how exactly the public and the private sectors were going to respond. Right? The Fed had begun to signal as early as February, March, and April that it was going to unwind quantitative easing. But again, we were uncertain how this unwinding would be met by actors, public and private. In the months since the Fed's decision, we've seen emerging markets accuse the United States of using monetary policy to engage in currency wars, as Charles indicated. We've seen the Bank of Japan and the European Central Bank announce policies of negative interest rates. At the same time, as recent as last week, we've observed surges in equity prices and just last week a dramatic fall in commodity prices. So what does this portend for the future of monetary policy? And how can governments and private sector actors manage within this environment? These are the questions that we will address this afternoon and this evening. To get us started, let me introduce David Wessel. David is the director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institute and a contributing correspondent for the Wall Street Journal. David will also be the moderator for our keynote conversation with former Treasury Secretary John Snow and former Governor of the Bank of England, Mervyn King. That event starts in this room at 6 p.m. But between now and then, we have a lot of ground to cover. So without further ado, let me introduce David Wessel to get us started.
Dear friends, thank you very much. It's an honor to be here. It seems like a great room to be discussing monetary policy. This is what I imagine it looked like in 1913 when the original governors of the Federal Reserve got together. I suspect they haven't decorated this room since then, but the world has changed a lot. It's a bit humbling to do this with such distinguished scholars as Charles Goodhart and Michael Bordeaux and second-guessing Mervyn King. That's a bit of a, even for an arrogant journalist, that's a pretty big chore. But I thought what I would do is maybe pose some questions that I hope we'll get the answers to in the course of the afternoon. Now, those of us who covered Alan Greenspan used to always ignore any sentence he used that had the word extraordinary in it, because if he used the word extraordinary, it wasn't. In a story I did in the Journal, I counted that in one appearance before Congress in 1992, Mr. Greenspan used the word extraordinary a dozen times. In 1995, he labeled as extraordinary all of the following: economic reforms in Mexico, capital flow to Mexico, U.S. response to the financial crisis in Mexico, inflation in the 1970s, the size of future budget deficits, congressional willingness to do something about future budget deficits, recent changes in international financial market. Well, you get the idea. But he should have saved the word for the time that we've just been through. I mean, I can't think of a better set of circumstances for which the word extraordinary applies than the one which we've been through, as David just responded. I mean, when you think about it, the Fed cut interest rates to zero in 2008. That was 6 years ago. And I am certain that very few people, if anybody, thought that in December 2014, rates would still be nearly at zero, and the only issue would be, is it going to be for another 6 months, another 9 months, another 12 months, or whatever. The Fed's balance sheet was under $900 billion when Ben Bernanke became chairman in 2006. Today, it's over $4 trillion. The Bank of England has purchased 375 billion pounds of gilts. Mario Draghi is talking about adding €1 trillion to the ECB's portfolio over the next year, and my calculator doesn't go high enough to count the number of yen that the Bank of Japan has or will buy. Now, in some sense, the basic questions are the same. The lessons that we learned from Walter Bagehot in 1873, the lessons that we learned from Keynes and from Milton Friedman and Anna Schwartz. Some of the fundamental questions are actually surprisingly similar. But I think the channels and challenges are different. And from the standpoint of a recovering journalist, I want to talk a little bit about those challenges, and I'm going to rely on something that economists call stylized facts. As a journalist, I always loved the concept of stylized facts. And whenever any economist called me to complain about a story in the Wall Street Journal that didn't have the nuance right, I would just always ascribe it to stylized facts. So what does make this time different? What does make this extraordinary? Well, for one thing, in the wake of the extraordinary period we've just come through, central bankers loom larger than ever in the political and public mind, and for good reason, even though the Pew Research Center recently did a poll that gave a cross-section of Americans a list of 4 possibilities for who was the chair of the Federal Reserve. 1 in 4 picked Janet Yellen, 17% picked Alan Greenspan, 11% picked either Supreme Court Justice John Roberts or Justice Sonia Sotomayor, and 50% even refused to guess. But central banks have taken on much more responsibility for regulation and supervision in the wake of the crisis. The paralysis of fiscal policy, particularly in Europe, has added on the pressure for them to deal with not only the familiar task of short-term economic stabilization, but also with severe downturns, and the possibility that budget deficits will be persistently large as advanced economies cope with aging populations. And that list doesn't even begin to describe Mario Draghi's role as kind of the sometimes seems like the sole force holding the Eurozone together. Now, all of this attention, all this responsibility carries substantial risks for central bankers, I think, and I'd be interested in what Mervyn King has to say about this later. But it seems to me that the public, politicians, may be expecting too much from monetary policy here in Europe and the US. I mean, I think the question to ask is, are we asking too much of the central banks? Not only for for their old role of preventing inflation, but some people think they can restore us to full employment. Some people talk about them having a role, despite the textbooks, in the long-run potential growth of the economy. Some people blame them for the current widening of the inequality gap. And of course, we've asked them all to take responsibility for financial stability. So the first question is, have we asked them to do too much? Secondly, I'm thinking of discarding the phrase unconventional monetary policy. I mean, after all, what has been considered unconventional, large-scale purchases of long-term assets, extraordinarily low interest rates, forward guidance where central banks promise to keep rates low for a long time, will permanently be part, I think, of the central bank toolkit, although that's an open question, and I think it complicates their jobs a little bit. I mean, to go back to Alan Greenspan for a moment, Alan Greenspan used to say with a straight face that the Fed controlled short-term rates, the bond market controlled long-term rates, and he had nothing to do with them. Well, that wasn't true then, but no central banker, at least in the United States, will be able to say that with a straight face in the future. And I think the recent period has really highlighted the extraordinary, to use that word appropriately, importance of central bankers' words. The spread of forward guidance as a tool of monetary policy has been evolving for some time. It's come a long way from Montague Norman's famous quip that central bankers should never explain, never excuse, from Paul Volcker's mumbling, from Greenspan's quip that if you understand what I said, I made a mistake. Mario Draghi has illustrated just how powerful the words of a central banker can be. He's yet to spend a single euro to back up his whatever it takes line, but he turned around the markets. And of course, all this talk has led to inflation, not of the price kind, but in words uttered by central banks. The Dallas Fed did a great chart of words per FOMC statement, and it looks like inflation in the 1970s. So I think that the importance of the central banker's words is much more important than it has been before. And just today, Kevin Warsh, former governor of the Federal Reserve, was hired by the Bank of England to examine their communications and transparency and talked at great length about the role of transparency and the reasons for it. He said that in the statement with the report that the Bank of England released today, he said, transparency is not a virtue in and of itself. It's a virtue for what it can do. He said it can help central banks communicate effectively so that the signal is heard through the noise. And I think this is important, another reason is, as he put it, to overcome any democratic deficit common to central banks, which are, of course, designed to be independent of elected politicians, sometimes to the discomfort of those politicians and often to the puzzlement of the public. So the art of being a central banker has always been evolving. I think it's changed a lot. And the question is, how much will their communication tool be a standard feature of the years going forward? How well are they using it? And of course, what are the risks to this kind of increased transparency and more forward guidance? Third, you know, there's a kind of a dirty secret among economists, which is it's really hard to explain how quantitative easing works. When Ben Bernanke spoke at Brookings earlier this year, he joked and got a lot of laughs for saying that quantitative easing works in practice, but not in theory. And I confess to quoting him every time National Public Radio asks me to explain what quantitative easing is. I get away with telling him that, you know, if the central bank buys a lot of bonds, then those people who had held bonds need to put their money in something else, and that something else is often stocks or real estate, and that raises the price of those assets, and that's good for the economy. And I can kind of get away with that. But I've had a really hard time convincing ordinary people about what economists call the signaling channel, the notion that the Fed had to spend $3 trillion to convince people that it would really keep interest rates low for a really long time. So I think there's a bit of problem about QE. Andy Lowe at MIT has observed that there's still no coherent narrative about the crisis. I'd submit that the same might be said about quantitative easing. And one subset of that is this interesting question, one which we're going to take up at the Hutchins Center early next year, is does quantitative easing make inequality worse? I think there's a popular view, and it's actually shared by some central bankers, to my surprise, Dallas Fed President Richard Fisher and Kevin Warsh, who I mentioned earlier among them, that there's a certain logic here. The gap between winners and losers in the economy has been widening. quantitative easing involves pushing up asset prices. Rich people hold more assets than poor people. Therefore, some of the increase in inequality we've seen is due to this unconventional monetary policy. Now, I think this is an important narrative because I think it accounts for some of the unpopularity of the Fed and some of the skepticism about QE. But clearly, it's much too simple a story, one that ignores the impact of easy money on debtors, who tend to be poor, versus creditors, and of course, one that ignores, as the public so often does, the counterfactual. So do we really think there would have been less inequality or more growth had the Fed not engaged in quantitative easing or the Bank of England and stuff? Nevertheless, I think this is one of those beliefs that's really going to have political consequences, and it may affect the ability of the Fed and other central banks to maintain their independence. I mean, I was taught that the reason we have independent central banks is to prevent politicians from pursuing policies that will create too much inflation, and that we let politicians gripe about the Fed being too stingy, but we don't have to worry because they don't really do anything about it. After all, the Congress of the United States, deep in its heart of hearts, knows that it's made such a mess of fiscal policy that every time they get close to interfering in monetary policy, cooler heads prevail, or at least they have so far. That's not necessarily a permanent condition in the sense that somehow the Fed is responsible for the remarkable rise in inequality in the United States is not going to help their political cause on the Hill. And finally, as I mentioned earlier, we've really broadened, in some case made explicit, the role of the central bank in maintaining financial stability. And I think that raises a host of issues. Now, of course, the origins of modern central banking in Bagehot's time and the creation of the Federal Reserve in 1913 in response to the panic of 1907 reminds us that central banks were created to do more than just maintain low inflation and keep and sustainable employment. The pre-crisis mantra was that the central bank should adopt an inflation targeting strategy and everything else would work it out. The new one is a little complicated. The central bank should use interest rates to meet its inflation and employment targets and rely primarily on something called macro-prudential tools to maintain financial stability. Now, this has an appealing simplicity to it, but I think it raises a lot of questions in practice, and it raises a lot of political challenges. I mean, take housing. I was taught that housing is one of the primary channels through which conventional monetary works. The Fed raises interest rates on mortgages go up, that cools off the housing industry, or vice versa. And that was certainly what we thought the Fed was doing when it bought a lot of mortgage-backed securities. Okay, but when the Bank of England Financial Policy Committee moves the loan-to-income ratio to restrain borrowing from housing, and indirectly, though they don't admit it, housing prices, we're supposed to think that's not monetary policy, that's macro-prudential. I'm not sure that that the distinction is quite so clear. It's certainly not going to be clear to people who can't buy a house. I mean, and in addition, for better or worse, we have a lot of economic models that give the central bank some sense of if you move short-term rates by this much, then this is likely to happen to long-term rates, and that's likely to happen to the economy. We have, as far as I know, no good way to calibrate this macro-prudential tool, whatever it is, and the Fed doesn't really know. So do we turn the macro-prudential dial 16 degrees to the right? What effect will that have on the markets and on the economy? Minutes of the Federal Open Market Committee suggest that it goes something like this. They know they have to worry more about financial stability. So they have a little team that comes before them and says, okay, we've looked over the whole horizon, and we see a couple of pockets of excess in the financial markets, but nothing really bad for you guys to worry about. So the Fed checks the box, financial stability check, and they go and make monetary policy decisions the same way they always did, with using the familiar discussions of the macroeconomy and the Phillips curve and inflation and unemployment and stuff like that. But even if the staff someday came to the FOMC and said, we're ringing the financial instability alarm bell, there really isn't any good way for the Fed to calibrate its macroprudential tools. And in fact, in the United States, the Fed has fewer tools than some other central banks do. And that's before you even get to the politics of this. By their nature, macroprudential tools, unlike interest rate increases, have targets. And people who get targeted don't tend to be quiet, at least not in this country. So imagine that one day Janet Yellen has a press conference. She said, we've decided that too many people are buying houses. So we're going we're going to use our power to make it less attractive for banks to make mortgage loans. You know, that is what macroprudential policy is. It's if they think something's going on in housing, they should do something to restrain it. If they're ever explicit about it, there's no guarantee that the political backlash won't completely swamp them. I mean, we learned in the run-up to the crisis that when the Fed and other financial regulators tried to put some guidance to the banks about maybe you shouldn't lend for so many commercial real estate buildings that are never going to be leased, that they got the eventual guidance was so watered down before it came out, and it took so long to come out, that Janet Yellen herself, in testimony to the Financial Crisis Inquiry Commission, says it was useless. And that was commercial real estate. Imagine housing. Okay, I could go on. My point is this, that the arrival of unconventional monetary policy is accompanied by some new economic puzzles. The broadening of the responsibility of the central bank, particularly in financial stability, raises a whole lot of political challenges. We know that things have changed. I have a pretty clear idea of the questions. I don't have very many good ideas about the answers, so that's why I'm glad I got to speak first here today. I'm happy to take questions or divert them to Charles Goodhart about this, or why the press does what it is, or what was it like to work for Rupert Murdoch, or anything else that's on your mind. Pari? I think there's a mic coming.
Oh, sure. Pari Sastry, Brookings Institution. So for your question about the loan-to-income value ratio manipulated by the Bank of England versus MBS purchases, wouldn't you say that MBS purchases would have an effect broadly, so it's more of a blunt instrument, but the loan-to-income ratio is more targeted, and so that's why that's not monetary policy, but MBS purchases are?
Well, it's easy to make the case that interest rates are monetary policy because they go throughout the economy. Once you start targeting one sector, I think it's a question of where you draw the line. So you're saying if you target all of housing, we call that monetary policy. If you only target people who have who are trying to borrow a lot more than their income, that's macroprudential. I think that's a pretty fine distinction. I can understand how you can assign responsibilities. I mean, to some extent, bank supervision has macroeconomic effects, and we learned what happens if you don't take those into account. But I think that the notion that somehow we'll use macroprudential for financial stability and interest rates for the broader macroeconomic goals makes things a little more simple than I think they are in practice. Yes. Why don't you wait for the mic?
Hi, Burcu Duyganban from Federal Reserve Board. So one question I would add to your list of questions of the things that we don't understand, and this is coming from someone who helps the Fed check the financial stability checkbox, as you were talking about, is, you know, you said that we have relatively, at least some understanding of the relationship between interest rates and the rest of the economy. We really don't know what that relationship is with financial stability in the financial sector at large. And a lot of the discussions on financial stability, there's an implicit assumption that we know that, because we focus on low rates and impact on financial stability, which assumes that if you raise rates, that's good for financial stability. And I would just say that that's another area where I think there's a lot to be answered and studied.
I totally agree with you. I totally agree with you. I mean, one of the things I've noticed about the recent period in macroeconomics and monetary policy is people make statements with a great deal of confidence for which there is very little evidence. And you're kind of touching on one of them. There's this kind of intuitive notion that somehow, if you have low rates for a long time, that a whole lot of people are reaching for yield, and there's a whole lot of risk building up in the system. And even though we're looking for it, we can't find it. So therefore, we should tighten now and put a whole lot of people out of work to avoid some bubble that may or may not happen. That's sort of the Wessel's summary of the Bank for International Settlements view. And you make the very good point that it's more of an open question. I agree with that. Paul.
I want to ask David Paul Wanacott, University of Maryland. I want to ask a rather broad question, which is a bit beyond what you've been talking about.
I thought it was pretty broad.
even broader. We've just gone through 6 years of the greatest crisis in the last 80. There have been attempts to try to ensure that that doesn't happen again. And it seems to me those have not been entirely successful, although we won't know for another 25 years. But I wondered if you would like to talk about the reforms that have been made and the ones you think that are good and the ones that should have been made and haven't.
Should have stopped at 2 questions. So I think we have, my opinion, for what it's worth, is we have made the system more resilient. That if nothing else, we learned that the banks were undercapitalized relative to the risks they are taking, and undoubtedly with a lot of complexity, maybe more than we need, we've required the banks to have more capital, and that should make them more resilient if we have another financial shock. There were clear gaps in the regulatory architecture, both here and abroad. I'm more familiar with the ones here. It clearly is something wrong with the financial architecture when a company can get to the size of AIG and pose so much risk to the financial system, yet it was regulated by the Office of Thrift Supervision, which, shall we say, lacked the respect of its peers. So we fixed that. I am persuaded that we gave the Treasury and the Fed painfully few options to deal with the collapse of a non-bank financial institution, hence the messes of Bear Stearns, Lehman Brothers, and AIG, and that we've at least put in place a system that might deal with that if it happens again. We have a legal framework. Whether it'll actually work, I have no clue. I'm still trying to imagine what happens if the FDIC tries to resolve Goldman Sachs or something like that. It seems to me that's maybe beyond their capacity. So what are the things we haven't done? Well, as Lehman illustrated, and as Mervyn King once said, global financial institutions are global in life and national in death. We haven't really fixed this cross-border resolution thing, and there's a lot of cross-border. Secondly, I think that we haven't, I don't have a strong view about too big to fail in the United States, but there is certainly a bit of public allergy to the notion that we were led to believe that we didn't want to have banks that are too big to fail, and the banks in many cases are bigger than they were before the crisis. Although I think that even the recent decision by the Federal Reserve to increase the so-called SIFI surcharge, showing that they're trying to shrink the banks using the lever of capital requirements, which I suspect will be successful, that if essentially it'll make it so unattractive to be big that unless there really are economies of scale, there will be less incentive to do it. Paul, you and I have talked about the outrage that the rating agencies, which got so much blame for the crisis, have gotten so little reform since then. And I don't think that anybody in their right mind thinks that we've landed at the optimal organization of financial regulation and supervision in the United States. I mean, the FSOC, the Financial Stability Oversight Council, is a hodgepodge that was organized because the political constraints from doing anything more rational. My colleague at Brookings, Don Cohn, who's on the Bank of England's Financial Policy Committee, has written some about the advantages of the British system, which is somewhat more logical, a Financial Policy Committee and a Monetary Policy Committee. But I think we've already seen tensions within the FSOC and competing mandates. Is the SEC have a financial stability mandate? Why did it take so long to do anything about money market funds when everybody knew they were a cause of making the problem worse? I think my bottom line is we've done a lot, we're better off, but we're not safe. Sir. The only people who get exercise are these things, the people who walk around with the mics.
Thank you for coming. I'm George Shambaugh from Georgetown University. You talk about the increasing political role that central banks are making, central bankers are playing. To what extent do you think that central banks can substitute for political intransigence or compensate for political uncertainty?
Well, I think in some cases, I mean, the short answer is not very well. In some cases, they had no choice. I mean, if you're at the Federal Reserve, if you're Ben Bernanke and the world's falling apart and you think we have a risk of another Great Depression, and Congress is, the Treasury has no legal authority to deal with this, and your judgment is that Congress won't give the Treasury authority in time to prevent Great Depression 2.0, you kind of have to fill the vacuum. You justify it by saying, I have a mandate, price stability, maximum sustainable employment, and I am pursuing that mandate. But in fact, I think we asked the Fed to do things that the political authorities should have done and didn't. I think, secondly, I think central banks, not so much in Japan, but here and in Europe, different case in Britain, have compensated for what I consider to be inappropriate monetary fiscal policy. That is, what do you do if you're a central banker and you think the fiscal policy is too tight? Do you take a caricature of the Jean-Claude Trichet line, which is to say, I'm not going to cut interest rates until you guys do the right thing on fiscal policy. I'm going to make you suffer until you give. Or do you do, caricature again, the Bernanke thing, which says, if you're going to run too tight fiscal policy, I'm going to have to do more monetary policy. Don't complain about quantitative easing. So I think that's the thing. I think there's the trade-off there, and I think that we run the risk when we ask central banks to act when the fiscal authorities should act and don't. And Europe is just a whole nother category of how difficult it is. I often think that people say Janet Yellen has a difficult job. She does. Mario Draghi has a more difficult job. I mean, the limits of a monetary union without a banking union and a fiscal union are now evident. Although economists are often blamed for never seeing anything, there were kind of economists who kind of warned this was going to be a bit of a problem, and it is. I think that just on the uncertainty thing, I'm not sure. I think central banks have done a pretty good job of trying within their limits to create some certainty. I think there was a lot of trial and error. The forward guidance that the Fed did and the Bank of England did was not always very good, and I think they learned. And I think they've tried to find ways to both convey what they think is going to happen, but also as best they can to convey where they see uncertainty. Turns out that markets really don't like someone to tell them we're a little uncertain and what our decisions are going to depend on what happens. And people always seem to think like, yeah, you don't really mean that. You just have a secret plan in the back of your head. But if I had to compare in our system, not so much the parliamentary systems, in our system, if you were rating the monetary authorities versus the fiscal authorities on certainty, you got to give the Congress an F, and whatever grade you give the Fed has to be higher. I mean, Congress is right now arguing about whether to extend tax credits that expired on December 31st, 2013, that were supposed to influence business decisions in 2014. And if we're lucky, they will make them retroactive, 3 days before the end of the calendar year. I don't know any theory of economics that says that giving people incentives after the fact is the optimal form of tax breaks, but that seems to be what the Congress has adopted. One more if there is one, if not? Okay. In the back?
I'm an attorney, not an economist. And
We won't hold it against you.
I don't know finance. I did work for the Justice Department at one time and helped to break up AT&T, a very large corporation in its day. This is global, and I'm very curious. I heard some comments yesterday at Carnegie Endowment from the EU ambassador to the United States. China is my question. You didn't mention it very much. We're looking forward, not backwards. What do you see their role being in a more stable monetary environment, if you will?
Well, I think anybody would have to agree that China's role will be huge. So where if we had been having this conversation 20 years ago, it would have been possible to have a conversation about global flows of capital and interest rates and trade and kind of make China a footnote. Today, it has to be higher up. And you're right, I probably should have mentioned it. I think the short answer is we don't really know. We just know that they have a lot of money, and it's been really helpful to the United States that they decided to put it in U.S. Treasuries, because it's managed to allow us to keep interest rates low when we borrowed a lot of money. And I worry some that we have taken that for granted. I understand why it happened. If you were managing the whatever $3-4 trillion in reserves that the Chinese had, and your boss said to you, I think we have too much exposure to the U.S. After all, they don't seem to know how to run their economy. They don't have a credible business plan. And the boss asked you to come up with alternatives. And you'd come back to her and say, okay, so here are our choices. We have a lot of money, so we can't play in the small markets. Japan? Well, Japan is a shrinking population and an almost explicit policy of cheapening their currency. Doesn't seem like a great bet, and besides, they have even more debt than the United States relative to GDP. The UK is doing great, and we can put like 1.2% of our reserves in there. And Europe can't even decide if it wants to have a currency. At least the United States has going for it, with the possible exception of a few people in Texas. We've kind of agreed we're going to stick with the dollar. So I think the U.S. has been lucky, but the U.S. is the world's tallest midget. And I worry that we're hooked on all this flow of money from China, and someday we may discover that either there are alternatives, or that they finally decide that maybe they should invest more of their money at home and less here, and we'll learn the hard way what happens when your market dries up. So they don't have an independent monetary policy. They clearly manipulate their currency for the benefit of their trade balance. They're clearly making a remarkable move to a market economy. They are almost certain to have a harder time over the next decade than they did over the last 30. No one can keep this up for another 10 years. I'd be shocked if the next 10 years are like the last 30. But it kind of takes your breath away when you see what they've accomplished, and they will be a player in the world global financial system from now on, and we better get used to it. And while we're at it, we ought to give them a little bit bigger share of the quota at the IMF, which is another one of the stupid things that the current Congress has refused to do. Thank you very much.
Thank you, David, for getting us off to an extraordinary start. We're gonna break for about 10 minutes. The next session will start at 2 o'clock.